Welcome back, everyone, to the Biz Beat by SVA, where we help business owners, investors, and leaders stay informed about what's happening in taxes, policy, and strategy. I'm your host, Lee Schwartz, Director of Business Development and Sales here at SVA. But you might notice, especially if you're watching us on YouTube, that I'm not joined by Eric Trost, our president, today. Eric is gallivanting around Orlando, Florida at the moment with his family. So instead, lucky to be joined by Ted Ibinger, a principal in our real estate group. Ted, happy to have you here. How you feeling? You nervous?
A little. First time on the podcast, Lee, so thanks for having me. Avid listener on Spotify.
There you go. Good. On Spotify. Well, good. It's good to know where people are listening to us. But Ted, we wanted to have you on. I mean, we get a lot of questions specifically about real estate related topics. So we've got a bunch. We'll kind of fill your plate with real estate topics here today. But before we dive in, I just want to remind everybody to check out our One Big Beautiful Bill Act hub on our website. So that's sva.com/OBBA, OBBBA. It's packed with summaries and FAQs, biz tips, past webinars, scheduled upcoming webinars, all sorts of information on this bill that recently passed, the latest, everything that's in the legislation, and how it can impact you and your business. But Ted, let's jump in here. So one of the questions we get a lot of is the real estate professional election. So we've got developer clients who focus 100% on real estate. We've got a lot of business owners who own real estate. Can you give us a little bit of an overview of what that real estate professional election is? And then maybe in a little bit, we can talk about what the benefits of it are.
Yeah, great question, Lee. And I just want to start that I actually had a potential new client meeting last week. So this is perfect timing for this. Questions related to this, what they're trying to do they qualify as a real estate professional? So perfect timing. We get this a lot with new clients that we do get. So with the real estate professional election, there's about 4 tests that need to be done to see if you qualify. The first is going to be, do you participate in real estate related activities? And what those activities are real property development, redevelopment, construction, reconstruction, acquisition, conversion, management, rental operations, leasing, brokerage. So obviously you need to be in real estate, and that's what that actually means. So the next test is, do you work 750 hours or more in real estate activities? And I'll be honest with you, those first 2, everyone usually qualifies for. It's these next 2 steps that really can cause the issue. And the next one is going to be 5% ownership. So, and where this becomes an issue is, do you have a W-2 job? And do you own 5% in that entity if it is in real estate? And that's going to be our issue, because in the next step is greater than 50% of your time spent in real estate. And that's a lot of times where we see people that fail to meet that test. And where that comes into play is it's math, right? If you have a W-2 job and you're working 40 hours a week, well, you have to work a lot of hours in a year to clear that 50% test for the real estate professional.
So essentially a full-time job, would you say that mostly just takes the real estate professional election off the table if somebody's working a separate W-2 somewhere else?
In most cases, yes.
Okay.
Where it comes into play, and we're going to get into probably some of these items later, is, well, can you support the hours? Because that's the first test the IRS is going to ask. I would say you're more likely than not to fail when you have a W-2 job, especially if it's not in real estate. That's going to be your main issue.
Okay, so that's a big red flag for the IRS. I know we're going to talk a little bit more about the what happens in an audit for somebody in real estate as well. So maybe we're getting a little ahead of ourselves. So we'll come back to that one. But Ted, as I mentioned before, so I know this is a very advantageous thing. Talk to our listeners about why it's so advantageous and why you want to be able to qualify for this if you can.
Yeah, great question, Lee. So real estate is usually considered passive. So think of it, if you have a tax return, you might have ordinary income from wages, dividends, interest income. If you're a real estate professional, that income is now non-passive, so you can use losses in real estate to offset other sources of income that you have. Another huge item for being a real estate professional is if you sell the property down the road, say 5, 10 years from now, you would buy a property, you're going to sell that. Well, that gain on the sale is no longer subject to net investment income tax, and that's an extra 3.8% that you do pay if you do not qualify as a real estate professional. So you have two things, One, the first one is going to be you can offset other sources of income, and where we get those, losses from real estate is going to be depreciation, and where that comes from, and especially if you're buying a new property or you're constructing a new building, you're having a lot of first year costs because it might not be leased up all the way. So you might have some losses that you can use to offset other income on your return. Um, we have some other items to just be careful on because we have some, ever since the Tax Cut and Jobs Act, we have some limitations, I should say, where your net operating loss could be limited. So just because you have a bunch of losses doesn't mean you can necessarily take it on your return. And then also there was a new 461 limitation where you're limited to your business losses before it gets to the NOL bucket. So there's a couple things to just be careful with there. But in most cases, making the real estate professional election, then you'll be able to offset your losses with other income. And I do want to make one more point is if you are married filing jointly, only one spouse needs to qualify as the real estate professional. So that can be a big, maybe a big item that people don't think about, right? As they're, looking at what they're doing in real estate. And if maybe one of them has a job, but the other one's doing more of the real estate work.
So Ted, I mentioned this on the podcast a lot because I've been with SVA for now 14 years, but I'm not a CPA. I don't understand this stuff like you guys do. Can you break down a little bit for us? So let's say you qualify for this. Compare that a little bit when you talk about some of the operating losses or the depreciation that you can take as a real estate professional. Compare that to like if you're a business owner and you build a new facility. Now, it might be an expensive facility, but that's going to be it's going to be handled differently from a tax perspective. Can you sort of dumb it down, at least for someone like me, to sort of explain the difference between how a real estate professional and a non-real estate professional, how that would be treated?
Yeah, so great question, Lee. So in the case, just say you're a business owner, and then you might have some real estate. For your example here, you might have some significant build outs on the real estate, and so you might have some significant depreciation now that we have 100% bonus depreciation back. Well, if you're a real estate professional, all of those losses where you just took bonus depreciation, those are deductible versus your other income. And at 100% bonus depreciation versus, a normal business owner not in real estate, that's going to be suspended on their tax return. They're not going to be able to take that. So think of someone just highest tax bracket, just for an example, 37% right now. Well, someone that's not in the business of real estate, doesn't qualify for real estate professional, that's 37% you're not able to deduct against your other income.
It's
Just
significant.
Yeah, and that's where I wanted to say the high tax bracket, just to put that into perspective, right? And if you have income on that, you're paying an extra 3.8% if you're not a real estate professional. So your federal rate goes up to 40.8% if you have income.
Right. Okay. So I get it. It's I mean, this is a big difference. If you qualify for this, it makes a real meaningful impact on your taxes at the end of the year. Great. Thank you for walking us through that. Let's sort of stay in a similar vein. You talked about depreciation. Um, One of the things we talk to our clients a lot about, and I know there was, with some of the under the Tax Cuts and Jobs Act and some of the phase outs, there were varying degrees of interest in cost segregation studies. But maybe just real quick, can you give our listeners sort of an overview of what a cost segregation study is and the benefits that they provide?
Yeah, another great question. So We work with various three parties that have engineers. They have a full staff that essentially will go in. We'll give them either the closing statement, the construction contract. They'll look at the architect plans, everything to build it. And what the cost segregation study really does is they're going through and they're looking at what can we move to 5-year property, 7-year property, and 15-year property. So before we get into what that actually is, let's take a step back. So residential property is usually depreciated over 27 and a half years, and commercial property over 39 years. So in most cases, you would have a breakdown between land and building when you buy a building, right? You're going to have the dirt it's on right there, and then you're going to have the rest of your cost building. What the cost segregation study will do is they'll go through and they'll actually allocate what part of that is 5-year property. That's going to be all your furniture and fixtures. They're breaking out, appliances, fans related to the counters. They're looking at what pieces of this building is actually related to that. You'll have some 7-year property, usually not as much, but and then your 15-year property is usually going to be pretty big, which is going to be anything like site improvements. So think of your parking lot, your sidewalks, your railings outside, anything related to that. A lot of times you're going to have a lot of retaining wall work depending on where the site is, all of those costs. And why that's important to get it in the 5, 7, and 15-year property is because now with the One Big Beautiful Act, that's eligible for 100% bonus depreciation. That was set to phase down, and that was going to be, 80, 60, 40, 20 to 0 is what we were going to be until we got this, the bill that came out. So we're back at 100% bonus depreciation. So the big advantage of the cost segregation is, well, now we've moved costs, and usually this is pretty significant costs, from being depreciated over 27 and a half years or 39-year property to these classes of property where we can take bonus depreciation, and we can take 100% bonus depreciation now. I will tell you that the significance on this is from a historical standpoint from our clients. This is usually about 20 to 30%, low 30s of costs that now is bonus eligible right away when that's placed in service.
So essentially, you can depreciate that 20s to 30% of the cost of that building. You can depreciate it more quickly, essentially getting paying less in taxes up front. So it's not that you're paying less in the long term. It's just that it's sort of a time value of money. Do I understand that correctly?
100% correct.
Okay.
It's how can you offset other income that you have, or you might have properties that you've done cost segs in the past that are now kicking off taxable income. Well, we can use, this cost seg study, this bonus depreciation to offset that right away. So huge advantage right there. If you're placing a building in service, or even if you're acquiring a building, you can do that on an acquisition of an existing building as well.
Oh, you can. Okay. And I know that depending on the building, I mean, an office building and a warehouse are two very different buildings, or a lab. Um, any sort of rule of thumb and when these start to make sense? I would imagine, you buy a 1,500 square foot office condo, it might not make sense. But is there sort of a rule of thumb where or a value that these tend to make sense at?
Yeah, great question. Value, the answer is it depends. I would say though, you're probably looking like 750,000, 700,000 usually at least. Just because if you do the math of what you're going to pay potentially for the cost seg study to then also what your bonus eligible depreciation is, it's, if you have a $3 million property, way more makes sense. I had a client this last year where I think the one of the houses they bought was $700,000, but they also had another 3 buildings purchased in another entity. Well, we did the cost seg study because we knew we had a big ordinary income hit that year, so it made sense just to do it for all of them to get those extra deductions. I will give you the just caution on this is you don't want to do the cost seg study if you're looking to flip this in a couple of years. It just doesn't make sense on the depreciation recapture. So you're want to make sure you're holding this property for a longer term for it to make sense.
Yeah, you mentioned recapture, and I think that's a topic we need to get into at some point in the future too, because I think that's something people need to understand who aren't maybe intimately familiar with what that means. But Ted, you talked about a couple of different things, both as we were talking about the real estate professional election and now the cost segregation as it relates to sort of red flags and things to look out for as it relates to audits. And I want to get into that, but this is our mailbag piece. Um, so I just want to remind everybody you can submit your question to bizbeat@sva.com, or you can submit them on our website at sva.com/bizbeat. So Ted, yeah, we get a lot of questions about how likely am I to get audited, and what's the IRS looking for? So let's think about this through a real estate lens, and particularly what you were just talking about. Um, for real estate professionals, what is the IRS sort of looking for here? What are those red flags? And then what's been your at least recent experience with how these have gone?
Well, I have one, or I should say, we have one ongoing right now with an audit with the IRS. This was a tax period that we did not prepare the return for. We took on this new client in the last year, and now we're assisting with the IRS audit is what we're doing. And the very first thing, so well, I should say, with the IRS, they almost have like a checklist, right? That they're kind of going through the line. They're asking questions of what kind of get to know maybe the client, what they do, where they spend their time, what they work in. But the number one thing on the list to send them is how do you qualify as a real estate professional, and send me the time that you spent in real estate. I think this one that we have right now is a slam dunk. They have like 20 rental properties and own a property management company, but they still are requesting this support that they qualify for a real estate professional. So, like we talked about earlier, they don't have a W 2 from a different job or a job that's not in real estate. So clearly their time is spent. We push back on that, and they still requested records for that. And the question is, well, what does that look like, right?
Yeah,
What
what
do
are
you need
those?
to
What do you need to show them?
Yeah, so there's nothing that is, oh, you have to do A, B, or C, right? What that is how can you prove the time spent? And you can put together a schedule, and some people do that to track their time. We always tell people, if you are a real estate professional, hey, make sure you're tracking your time. It's easier to do that as you go throughout the year. And maybe that's like, I'm going to do this, once every 2 weeks or once a month, and I'm going to get my hours in there versus, oh, now we have an audit and the 2022 tax year, and we've got to go back and try and recreate that support. You can recreate the support. That's not a problem. You might just miss some time, right? Is what it might come down to. And you can give them phone logs, calendar appointments, calendar books. You could have your own kind of log notebook or support on that. You could have some kind of an Excel schedule, whatever that might look like. There's no right or wrong answer that says, oh, you have to do this or you have to do that. I would say, though, it's interesting on this one, too. I think the client went back to like over a 2-year period, and I think they requested phone records from their provider just to help say, hey, this is where I spent my time. And I think they said they had 17,000 minutes on the phone of just real estate calls. And I mean, it's a time commitment when you're going back to recreate this, right? Because now you're trying to sort through all of this. So the best practice is, hey, when you're getting your stuff together, when you're doing that, make sure you have an idea of what that time looks like and the time you spent. It's not hard to get to the 750 hours in most cases, but when you do have another job or you're doing something else, that's where it's going to come into play with the 50% too.
Yeah. Yeah, and I would imagine too. It like you said, it's a lot easier to keep track of the stuff as you go than try to recreate it a couple years later. So it sounds like that would be your recommendation: is just be tracking the stuff as you go.
Yeah, and I do want to bring up kind of another point just on related to IRS audits and what we've seen in the past couple years now. I would say in my first 7 years at SVA, I didn't have one business audit. I've probably had 3 or 4 in the last 2 to 3 years now. And what the IRS is looking at on that, from that standpoint, is they see a return that's filed and there's a big variance from year to year. And in the year that was under question that we had, the client bought 2 new buildings in an existing partnership, had a cost seg study done. Well, we had over $1 million of additional losses in that year. So it's, triggering something on their end. And that's how that got flagged by their business department to audit that entity.
And so, what I guess maybe talk us through that, because as we've talked about cost segregation studies, what and maybe this audit isn't completed, but what's sort of the takeaway from that one?
I think we wrapped it up, and you always want them to be done before tax season, but the IRS isn't the speediest, I think, at getting through some of these sometimes. And so we got a clean audit opinion in March of 2025. That one actually went quicker than some of the other ones because I believe that started last September. But the other one that I had took like 18 months. So
Hmm.
it depends on the auditor, I think, what's on their plate, what's there. But uh, related to the cost seg study, we had a cost seg study done by a third party that does that. They do a high number of cost segs every year for taxpayers. Pretty much what we had to do was send them that support on the cost seg. After the first month, and we sent that, we kind of follow up with the IRS. They said, "Oh, we're not checking, or we're not actually going to dispute the cost seg number." And me taking a step back, I said, "Well, what are we doing here then? That's the $1 million loss." And they still go through their full audit process to get through it. But once you clear that first hurdle, and we knew they weren't going through that, I'm like, well, we don't have anything to worry about. That's our biggest deduction on the return is the depreciation related to that cost seg study. If you're not going to go after that number, since we gave you the support, it's done by a third party. I mean, these reports are a couple hundred pages usually,
Right.
and that shows everything. It breaks down their property, what they did. It breaks down per unit. There's a lot of support there, but they still spent time going through everything else, and we ultimately got that clean audit opinion. And I will say too, Lee, a lot of these um, providers, they usually back up their support in the case of an audit. So if questions do arise from the IRS asking related to the cost seg, they will, do that, and they'll do that work for free usually because you've already paid for the study.
Gotcha. Oh, that's really interesting. So the what I'm hearing you say is that $1 million loss is probably what raised the red flag with the IRS. But as soon as the IRS sees that the cost segregation study was done by a third party and that there's substantiation to it, they were kind of like, oh, well, all right, we're not even really going to look at that. So it sounds like that's a real benefit of making sure you've got a professional who's doing that study for you.
Yep,
Yeah,
100% spot on there.
great. So Ted, we're wrapping up your first time on the podcast. What do you think? You think it went well? Were you feeling nervous?
I was a little nervous at the start. I guess if you guys need me back, I'm always willing to sub in again too. So it was a great first time, and I know we ran out of time, but we could, like we discussed, we could talk so much on some of these topics that we get from clients, potential clients, people that listen. Of what are they thinking of doing? What are they investing in? What are they looking to do?
Yeah, absolutely. No, thank you for taking our listeners through that. I'm already getting some live feedback, and everybody continues to comment that, please turn off Ted's camera. Uh, Ted has a face made for radio, but these are, we were expecting this. It's okay. Don't worry about it. We'll have to deal with all the social media dislikes that'll come out of this. But thanks for being here anyway. No, I appreciate it, Ted. It's great. That does wrap up today's episode of the Biz Beat by SVA. For our listeners, be sure to subscribe on Apple Podcasts, Spotify, or on YouTube, and share the podcast with another business owner or real estate professional that you know and think would benefit from it. Remember to visit sva.com/OBA for additional resources. And just a reminder, what we discuss here, as always, is general in nature. For your specific situation, seek out your CPA or business and tax advisor. And of course, if your advisor doesn't currently work at SVA, give me a call. Let's give that a fix. Now's prime tax planning season. Ted's getting busy, and we want to make sure he's as busy as possible. So give us a call, and we can help you out. Thanks again for tuning in, and we will see you next week on the BizBeat by SVA.
It's the BizBeat by SVA, breaking down the news of the day, from tax tips to business trends, smart insights from trusted friends. The BizBeat by SVA.